Okay, everybody, I think it's bang on 12 o'clock, so let's start. Thank you for joining us, and I'm sure we'll get more people joining us, so we'll go through the preliminaries first. My name's Russ Mould. I'm AJ Bell's Investment Director, and thank you for joining us today. Just a few details before we start. You can ask questions at any time during the presentation in the questions box, which is situated within the control panel on the right-hand side. Please don't be shy. These questions will only be seen by the moderator, and a selection will be chosen to answer at the end of the presentation in the Q&A session. If you do suffer any technical problems, then please report them in the questions box and we'll help you out as quickly as we possibly can. An email will be sent out an hour after the webinar asking for some feedback and also providing with information on where to download the slide deck. If you don't get this, please just quickly check your junk folder just in case. And do note that this session is being recorded. You will be able to watch a video on our website at some point in the next 2 weeks. Now, I'm planning to talk for probably 20 to 30 minutes, and then hopefully that will leave you with plenty of time for questions at the end. So here is the all-powerful disclaimer. So just quickly, please note that the value of your investments can go down as well as up, and you may get back less than you originally invested. We don't offer advice, so it is important that you understand the risks involved. And if you're unsure about anything, please do feel free to consult with a suitably qualified financial advisor. Tax treatments do depend on your individual circumstances and rules may change. And please also finally note that past performance is not a guide to future performance, and some investments do need to be held for the long term. So those are the formalities, and this is a quick run through of what we'll be talking about. The 5 key trends that I think shaped markets in 2019, the results in terms of performance that those trends provided. I think then the trends that will shape performance for 2020 and beyond, and then some conclusions before the question and answer session. Now, obviously, I admit we've got a big day coming up on Thursday and Friday with the election results, which may move the goalposts around a bit, but we'll do our best to help out with any questions that you may have there. So key trends in 2019, I think the 5 key things were central bank's policy pivot, a move from tightening policy to markedly easing it, a bit of a back to the future moment with technology stocks leading the way, oil and inflation, noticeable perhaps by their absence of the headlines they created, volatility, again, notable by the absence of headlines that it created or didn't create, and finally, just a look at gold. So central bank's policy pivot, when we were sat here a year ago, in fact, I think the last one of these we did was, the last preview we did was in January. There was still a bit of a consensus view that central banks would be looking to increase interest rates this year and not cut them, tighten policy and not loosen it. Well, that simply didn't work out. If anything, the Fed had already signaled that on the 4th of January that a bit of a shift in its policy when Chair Powell seemed to put interest rate pauses on hold. And the Fed has actually cut interest rates 3 times since this year. It's not on its own, it's just that the Fed has led the charge. And if you look at this chart here, the grey bars are interest rate increases by month from the world's central banks. The red line is interest rate cuts from the world's central banks. And as you can see, the story was all about rate increases in 2018 and rate cuts in 2019. And the very few increases this year have come from places like Moldova, Georgia, where there are specific economic problems. So that's not a bucket that you really want to find yourself in. So that's been the first big change. And the Fed has also, at the end of the year, begun to increase its balance sheet again, as we shall see shortly. So that's a huge shift. And I guess the question that it really begs is, should we be concerned? Because the world ultimately couldn't withstand 2.5% interest rates from the US Federal Reserve for more than 9 months, and neither could financial markets. So, but equally, markets have not been concerned because they feasted on the cheap cash, and they've taken the view that central banks will do whatever they can to sustain economic growth. Technology, and this is directly linked in some ways to the previous slide with central banks, and I'll explain why in a second. Tech got the year off to a dreadful start. A monster profit warning from Apple on the 3rd or 4th of January. Although oddly enough, that was the very day upon which that stock bottomed. And after that, it's been pretty much jingle all the way as far as technology companies are concerned. This looks at the New York Stock Exchange FANG index. So all the usual suspects in there, Facebook, Apple, Netflix, Alphabet, and so on, with the Chinese names chucked in, like Baidu, Tencent, for example. So those stocks have been tremendous yet again, confounding the doubters. And then one of the reasons why is these companies are perceived to be capable of generating secular growth in a low growth, low inflation world. And that is why they've proved extremely popular, despite the bad start to the year with a profit warning, despite increased competition facing people like Netflix, and despite the threat of increased regulation owing to ongoing concerns over privacy. So tech, same old, very, very popular all the way through this year, as it's been really for the last 3 or 4 years. The NASDAQ now way above the 5,084 peak that it set back in 2000. Oil is fascinating. It's generally a supply-driven market. I think oil demand globally has only dipped once or twice this decade. And certainly the one time it did dip, I think, was 2008, which, let's face it, was a very deep recession. It's supply that generally conditions oil pricing. And although OPEC stuck to its production cuts this year of 800,000 barrels a day, Russia stuck to its production cuts of 800,000 barrels a day, and sanctions in Iran from America and chaos in Venezuela all took out production. The oil price has found it really hard to make much progress this year, and it's been stuck in the $50 to $60 a barrel range for much of the year. OPEC has just rounded out the year, agreeing with Russia to a further 500,000 barrel a day production cut, taking their total combined cuts over the last 2 years to 1.7 million barrels. Knock off Iran, knock off Venezuela, OPEC production has gone from 32 million barrels a day to probably not much more than 28, 29. And yet, oil is still finding it hard to make headway, even though demand is growing consistently at probably 2% a year to around 100 million barrels a year this year. Why? US shale output is still soaring. It's gone up by over 1 million barrels a day this year alone to over 9 million barrels a day, and that remains an ongoing trend. The good news, however, is that cheap oil is generally pretty good for the global economy. And the OPEC members like Saudi Arabia, which is probably the kingpin there, have a difficult balancing act here. They clearly want to see the oil price relatively high because it funds their countries, their welfare budgets. And in the case of Saudi Arabia, would have helped them get the Aramco deal away, which actually began trading on the Riyadh exchange today. Equally, they don't want to jack up the oil price too much. You tend to then start getting tweets from a chap called President Trump. And also you tend to start putting the brakes on the global economy. This chart here shows that oil, when it goes up by more than 50% a year, you start to see global growth slow down. And if oil goes up by more than 100% year on year, then you pretty much get a recession. Certainly of the last 7 or 8 times that's happened, that big jump, you've had recessions follow nearly every time. And that's where the down arrows are showing the drop there in global economic activity, which are the thin blue lines. The good news is right now, for oil to be up 50% year on year, it would need to be in the mid 90s. For oil to be doubling year on year, it would need to be in the mid 120s. We're a long way from that. And I think this is one of the strongest cases for global growth in 2020, is that oil prices are not strong almost no matter what OPEC does. So few headlines written by oil, generally a good thing. Just remember the global financial crisis was partly precipitated, or certainly the global slowdown at the time was partly precipitated by a doubling of oil to more than $147 a barrel. So we don't want to see that, and thankfully we're not. The other thing that's been noticeable by its absence this year has been volatility. Again, we had the odd flash in early 18, late 18, a little bit in early 19 and summer of this year, but really not much at all. Headline indices have been relatively becalmed. Even if you've got wide dispersion in performance between stocks and sectors, the headline indices have not moved around desperately wildly on a day-to-day basis. The grey bars here are the number of daily moves in the FTSE 100 of more than 1% from open to close. You know, the annual average is something like 90. We're down still in the sort of 30 or 40s for this year. So it has, again, been a quiet year. The FTSE 100 generally flat as a mill pond. And in fairness, that's generally pretty good for performance. As you can see here, the more volatile things are, the higher the bars go, generally the poorer the returns you get from the market. So calm and peace is very much what's required. And again, this year in 2019, we've got it. And that's one of the reasons why overall markets have performed pretty well. Thank you very much. Gold, for all of the fact that things have been calm, Risk assets have performed well. Central banks have done their bit to keep the show on the road. Gold has actually had a pretty decent year. After 4 or 5 years in the doldrums since its peak in 2011-12, it's finally at the 6th or 7th attempt cracked the $13.50 an ounce mark. It actually got above 1,500, has just pulled back a little bit, but nevertheless, gold's up double digits this year. Gold miners have massively outperformed that, partly because of a wave of merger and acquisition activity in the gold mining sector. We've got the bid situation going on with Centamin right now. We've had a Chinese bid for a Canadian miner. We've had 2 Canadians, Kirkland Gold and Detour, coming together. And that follows on from in the last 12 months. Barrick Gold buying Rand Gold, buying in the bits of African Barrick Gold or Acacia that it no longer owned. Newmont buying Goldcorp. Gold mining executives seem to think there is value in gold mining stocks, even if generally speaking, they're still not attracting too much by way of attention. Now, confidence would be boosted if they were paying cash in these M&A deals rather than paper, but nevertheless, they seem to be positioning themselves for higher gold prices, which is a hint that we may need to consider at some stage going forward, particularly if we start to see not just loose monetary policy again, but fiscal policy loosened as governments and politicians thinking through their seats, literally and metaphorically, start to turn on the spending taps to save their jobs and try and boost growth. So where did those 5 themes get us? Well, these are the scores on the doors, ladies and gentlemen. This is total returns in sterling terms, and tech led the way with the FANG index there. Gold, as you can see, almost unnoticed, performed very strongly, thank you very much. Developed market equities did well, global equities did well, bonds didn't do you any harm at all. If anything, there was a weakness, it was in oil and in commodities. A lot of metals prices weak in the year. Copper, aluminium, iron ore, particularly nickel, rolled over right at the end of the year, which again, I guess perhaps comes back to questions over the global economy and whether it's really as strong as it looks. The good news there is Dr. Copper, aluminium, iron ore are actually all putting on a bit of a rally at the year end, even if nickel is rolling over because of the end, I think, of a ban in Indonesia on ore exports. But nevertheless, most things this year did you pretty well. In terms of geographies, Eastern Europe led the way. Who would have thought it? And it did that even without the oil price doing desperately much. Russia came out of recession. Its central bank governor, Elvira Nabiullina, has done a fantastic job. There were rate cuts there, and she's actually managed to keep that economy on the road pretty well. And don't forget, it was a ludicrously cheap market with the big fat yield and a very low PE. But I accept there'll be lots of good environmental, social, and governance reasons why many of you will not want to touch Russian equities with a 10-foot stick. Nevertheless, it was a classic example of cheap, unloved market, widely detested, doing very well. On a more mainstream basis, America led the way yet again. And note that it was generally emerging markets which struggled, with Latin America, Africa, Middle East, and Asia all in the bottom 4, along with the UK, which, while it provided a very nice return overall, thank you very much, I guess because of Brexit, general election concerns, whatever you want to put it down to, it was one of the laggards this year, as indeed it has been for the last 3 or 4 years. By sector, industrials did okay, tech did okay, consumer discretionary. So lots of confidence gathering again in the economy, helped by those central bank rate cuts. Energy down among the dead men because of, again, oil prices not really going anywhere. And I think increased ESG pushback possibly as well, and concerns that maybe oil assets will be left as stranded assets. Real estate, despite all the concerns over retail, wasn't a disaster, but it was still one of the laggards. And generally, it was areas providing cyclical growth or long-term secular growth that did best. And by bonds, it was one-way traffic. I mean, yes, they made you a profit, which is nice. They generated a positive total return. So the bond bull run of 30 years and more still running strongly as interest rates tick lower. Where you needed to be was long duration assets. Just look to the left-hand side of the screen. What did best? 30-year government bonds from America, Germany, Japan, the UK. The longer duration it was, the better it was for you, as rates perhaps unexpectedly came down a lot more quickly in the near term than people thought. Clearly, the flip side of this is, if there is any whiff of inflation at all, then these long duration assets are going to really hurt you, because their yields are tiny and their price movements will be substantial. So again, they've been great this year. They've continued to confound the bears. But again, the inflationistas out there will be wondering when this bond market finally cracks, but it wasn't in 2019. So 2020 and beyond. What we'll be looking at, I mean, we're all going to be looking at the general election result on Friday, but trying to move on a little bit beyond that. The issues that I think will dominate the headlines will be, again, central banks, I'm afraid to say, President Trump, again, I'm afraid to say, with trade and tariff policies, the yield curve, which I guess ties into central banks, growth versus value, which ties into the yield curve, and then banks, which probably pulls the whole lot together. Central banks, we've already looked at how we've gone from rate rises. We've already looked at how we've gone from rate rises to rate cuts. This just looks at Fed policy in more detail. The red line is the Fed funds rate upper band. The grey bars are probably even more interesting because this is the Fed's balance sheet that blew up from around $800 billion to about $4.5 trillion under quantitative easing as it hoovered up lots of government bonds, mortgage-backed securities, and goodness knows what else. And note that under QT, quantitative tightening, they sweated that down to about 3.7 trillion and then stopped. And it's gone back up because of their involvement in the overnight interbank funding markets or repo from September onwards. Why have they done that? Well, they've been pretty stum about it, to be honest with you. The fact that the overnight repo market went to, 8-10% rates suggested that somebody was in desperate need of short-term financing. Other banks and lenders weren't prepared to give it. Was it a bank? Was it a real estate investment trust? We may find out in time, but the Fed felt the need to intervene, and it's been getting stuck in with the result that its balance sheet's bloating again. So policy is being loosened in terms of rates. It's been loosened in terms of QE. But again, we're getting the question, they're having to go back to the same bucket, the same well, very quickly, haven't been able to get rates up very far, haven't been able to shrink QE down by very much because the global economy and the global financial markets couldn't take it. Are we reaching the limits of NERP, ZERP, QE, negative interest rate policies, zero interest rate policies, QE? Possibly. Christine Lagarde will be particularly interesting to listen to this week, the new president of the European Central Bank. She's going to make her first statements. She is pressing for more fiscal stimulus from governments. She is pressing for environmental issues and green bonds to be part of the ECB's mandate. We're hearing more about modern monetary theory, people's QE, green bonds, not cutting rates and things that maybe help financial markets, but things like direct investment in infrastructure, in green projects, I suspect could be the next leg if we move towards fiscal policy. That won't be necessarily the central banks will be involved, but I think fiscally, it's governments who may need to take the leeway as and when the next recession comes, because as far as I'm aware, they've not been abolished or outlawed yet. Trump trade and tariffs has been a key sentiment driver. I don't follow President Trump's Twitter feed, and trading off the back of it's a pretty bad idea, I would suspect, because he does flip-flop pretty quickly. But his policies on bringing jobs back to America, electorally, I think resonate. But history shows over time, nobody wins a trade war despite what he's saying. And we can see here, his policies are starting to have an impact on the American economy. This is the year-on-year change in the Cass Freight Index, a run of 10 straight months of declines. So you are starting to see some slowdown. You're starting to see that filter through into US heavy truck orders, which at some stages can start to filter through into durable goods orders and therefore employment. We've got the big deadline coming up on the 15th of December, a third round of US tariffs going on 156 billion bucks worth of Chinese goods. That deadline's come round and there's still no deal despite all the president's promises thereof. The markets are still thinking that there will be a deal, that will be a compromise solution, whether it's by the 15th of December or sometime in 2020, because the president wants to get himself re-elected on the 3rd of November next year. If I was the Chinese, I'd therefore be inclined to string him along. Yes, they need a deal too. The Communist Party's legitimacy rests on growth and jobs, but they're playing a 50 to 100 year plus game. Trump's playing a 12-month game, and the Chinese might just fancy their chances negotiating with a President Bloomberg, President Warren, or President Biden relative to the fun that they're not having right now in terms of dealing with President Trump. So you are starting to see some genuine legitimate impacts on the global economy from these policies. Markets are hoping that there's a deal coming soon. Hope is not a strategy, so we would like to see one fairly quickly. The yield curve. One of the concerns is that the Trump trade policies will lead to a global slowdown or, heaven forbid, even a recession. And this is perhaps some ways the ultimate markets recession indicator, the yield curve. Normally, as investors, if you lend money to a government, will demand a higher interest rate if you buy a 10-year bond than if you buy a 2-year bond, simply to compensate you for the additional risk posed by those extra 8 years. More things can go wrong in the interim. If you're a bondholder, that generally means inflation and interest rate increases. But what you do occasionally see is the 2-year yield moves down towards the 10-year yield level or even below it, and that is known as an inverted yield curve. Now, generally speaking, in fact, nearly always, recessions are preceded by an inverted yield curve as markets price in future interest rate cuts. However, not every recession is followed by an inversion. So every inversion has been followed by a recession, but not every recession has been preceded by an inversion. So it can give false signals. And it's just starting to steepen a little bit right now, which gives us hope that maybe the global economy, again, linking that into things like Dr. Copper and things like the purchasing managers indices, which look to be bottoming, are coming out of a bit of a growth lull, shall we say? Whether they're coming out of it because of looser interest rate policy, more QE, or what, we'll find out, or indeed even if they are coming out of it. But at least there's some little signs. But at the moment, the yield curve is still perilously close to flat to give us, maximum confidence that everything is okay. So it'd be nice to see that start to steepen a bit next year potentially. Now, if the yield curve does start to steepen, and that is an indicator that global economic growth is okay, maybe, just maybe, we don't need to buy pots of bonds. We don't need to buy lots of long duration assets, and we can actually get stuck into some cyclicals and some value. The market's tried this before. It tried it in 2016 and was wrong. It tried it in Q4 2018 and it was wrong. And it's kind of been trying it from September onwards. And as we can see here, we're just starting to see some signs that value is starting to outperform growth. When the line goes down, that's growth outperforming value. When the line goes up, that's value outperforming growth. So it's starting. But I think what you really need to see for value to have a sustained run at it is a little bit of economic cyclical growth, because then you don't need to pay huge multiples for secular growth. If cyclical growth is everywhere and you can find it lying down in the street, would you need, and you do it on cheap multiples, why would you need to pay high multiples for secular growth? So it would lead to a major shift in market leadership if it were to happen. So keep an eye on this trend for 2020 and beyond. And clearly that would affect either stocks that you research or even the funds that you research, because we know some funds and fund managers have a value style, some have a growth style, and therefore their performance characteristics or their performance patterns could start to change, because let's face it, it's been growth, momentum, and quality first and value nowhere for most of the last 10 years. Banks, they are in the value cyclical bucket right now. There's no doubt about it. You look at the big UK banks, with the exception of Lloyds, they trade on 1 times book value or less. They come on fairly lowly PEs. They come with fairly decent yields. And yet again this year, they have been dogs. They have not performed well. The banking sector's underperformed. Lloyds has put a bit of a wiggle on at the end of the year, but the others generally haven't been great in the UK. And this just looks at the global banking sector, going all the way back to 1995. Look at it since 2009. The global bank sector has been a horror. It has massively underperformed. Why? Well, if you're a bank, you need 3 things to help you make a profit and boost your net interest margin. You need positive interest rates. You need a relatively steep yield curve so you can lend at the shorter, lower interest rate, or borrow at the shorter, lower interest rate, lend at the longer, higher interest rate, and pocket the difference between the two. And you need credit spreads to be wide so you can, again, borrow cheaply and lend to corporates more expensively. All of those things are being crushed and ground down by quantitative easing and NERP and ZERP policies, which is pretty much what we've seen in Japan. And this is the opposite of the inflation case. It's the Western world isn't going to see inflation because of QE and because of ZERP and NERP. It's actually going to go and turn Japanese and see low growth, low interest rate, low inflation world for a very, very long time to come, or heaven forbid, even deflation. And this is what the banks would be arguing potentially. On the left-hand side of this chart, slide 20, you can see the Topix Banks Index all the way back to 1988, 2 years before the Japanese property and equity bubble popped. That then is run against the Japanese 210s yield curve. There you go. That's QE, NERP, and ZERP. That's what that's done to Japanese banks. It's driven them down by 90% as a debt bubble has popped, and it's taken a long time for asset prices to even try and recover. The chart on the right-hand side looks at the Topix Banks Index over that same time horizon since 1998, and then superimposes the FTSE All-Share Banks Index 2 years before its own peak, an own financial crisis, in 2006. It's not perfect, but it's not bad either, which is a little bit disconcerting. The good news is there may be an absolutely enormous rally coming, this middle bulge here, which saw Japanese banks run up by 250%. The bad news is it didn't last forever. UK banks are down about 65% from their 2006-7 peaks. The Japanese, again, are down 90. So if the West does turn Japanese, heaven forfend, banks will get it in their neck and they will not be great investments. And this is one way of tracking it. The good news is, if the West does not turn Japanese and you do get inflation and cyclical growth, the banks won't be very, very interesting because they performed like horrors. They're potentially cheap and they're genuinely unloved. So keep an eye on the banks. Now, Japan is interesting because if you look at this chart here, back to this table, Bank Japan was king of the world in 1990. And as you can see, this is looking at the world's biggest stocks by market cap. They were pretty much all Japanese. Everyone was saying, look, Japan's taking over the world. Michael Crichton even wrote his book Rising Sun all about it. And the consensus bet, just by the basis of the fact that they were the biggest company in the world, was clear this would continue and that Japan would dominate forever. You then get to 2000, tech stocks dominate, and the bubble burst in 2001, 2, 3. In 2010, the best performing stocks the previous decade had basically been China, commodity and commodity plays. Chinese index is now barely half where it was 12 years ago, for example, and commodities have generally been pretty soft this decade. So applying the same test, we get to the end of this decade, and lo and behold, it's tech stocks the king of the world again. So given that the last 3 really big decade-long run-ups have not then led to outperformance in the next decade, do you really want to take the bet that what's worked for the last 10 years is going to work again for the next 10? Oh, that's obviously a decision for you to take. But you're going to have to look at valuation, you're going to have to look at other things. And clearly the biggest game changer would be if we go from a low growth world to a cyclical growth world with inflation, because that is the one thing that this 10 years of performance in bonds and tech and long duration assets is not pricing in. The world is pricing in more of the last 10 years, low growth, low inflation, low rates. It's not pricing in anything different. So that, if there is a big portfolio surprise for the next decade, it's going to be the return of inflation because nobody is expecting it and nothing is pricing it in. Do I know whether it's coming or not? I don't know, but I've given you all the things that you need to look at, like banks and Dr. Copper, to carry out your own research and checks. So just by way of conclusion, we've used this before. This is Sir John Templeton, legendary fund manager, died a billionaire, clearly very good at it, well worth listening to. Bull markets are born on pessimism, grow on skepticism, mature on optimism, die on euphoria. So this is the panel that we showed a year ago, just looking at how things have performed, but more personally, the questions I was getting from the national press, from customers, from advisors, from clients, and what was out in the cold, what was unloved a year ago completely. Bricks and mortar retail REITs actually generated a profit. Even sterling and UK equities have rallied. Precious metals and miners have actually done very well, and even emerging market equities and bonds have done okay. I know, I admit everything did well last year, so it's not a massively fair test, you could say, but look how the ones that were out in the cold did pretty well compared to all the rest. Oil, which was an optimistic area a year ago, has done horribly, but yeah, there's no doubt about it, FANG stocks have led the way. So that's where we were a year ago. So again, looking in that dark cave where you didn't want to go, that was really where the treasure was, in the cold section in the top left. Yes, playing around with the others it was okay, but you're probably playing a lot more with fire in the bottom left in the red area than you are digging in the dark cave at the top level. Where are we now right now? In my opinion, this is just purely subjective again, not so much based on how things have performed, but the questions that I'm getting. What's out in the cold? REITs and bricks and mortar retail still, UK equities still very unloved, just looking at fund flows, and after Friday we'll find out whether that's justified or not. Emerging markets have been horrible, have underperformed this year. They've actually underperformed for the last 10 years. They've not compensated you for the risk you've taken because, again, there hasn't been a huge lot of global growth around for them to feed off, which means people haven't gone for cyclical markets like those, and they've gone for secular growth markets like quality names and, again, long duration tech names. Oil is now out in the doghouse, and income investing and value investing are still largely out of fashion relative to momentum and passive investing and quality and growth investing. There's a little bit less skepticism with regard to gold. It's gone up, but not a lot. Dollar's now moved into the skeptical bucket because people think that it should go down because the Fed's cutting rates, but it isn't. It's still going up, which is a little bit worrying. Optimism, Abenomics and Japan have actually kicked in a bit this year. Europe, people think that the ECB's got their back. And the areas where there's still probably a bit of, real Enthusiasm, almost euphoria. US equities have just had their another amazing year. FANGs and technology stocks, definitely. Now, cannabis stocks, I put them in there because I'm getting loads of questions about them, even though they've actually been dreadful performers in the second half of this year. Again, cannabis is called weed, okay, ladies and gentlemen, so it means it's dead easy to grow. And in a world where there's no shortage of funding for anything that people want to decide they want to do, I'm not sure that that's necessarily an area where there's massive barriers to entry. If you are looking for cannabis players, I suspect it's where you need to be in things like intellectual property areas like medicines, not just growing the stuff. But I await to be proven wrong, but those share prices have already started to shrivel, dare one say. So I think, again, be a little bit wary. And it's also an area where multiple exchange traded funds cropped up this year. Wall Street will sell anything that it can. So I think once, and it won't care particularly about quality control if people are trying to buy these things. So again, you probably just need to look at if there is a new theme coming up. Once you start to see multiplicity of investment products associated with it, you may need to think twice. So by conclusion, we need to think of all eventualities because central banks, right, a year ago were convinced we're going to get to tighten policy. Now they're loosening policy. So if they don't know the answer, we as investors cannot be dogmatic in our worldview. We need to be prepared for multiple eventualities. We could get inflation, fiscal response, Senator Warren, tariffs, oil shocks, fiscal, it could happen. We could get stagflation, the worst world of all, where we just kind of stay as we are now, or we could get deflation because global indebtedness is $100 trillion higher than it was in 2007. Debt is inherently deflationary because the money, the interest has to be paid. That sucks cash away from investment. Demographics are potentially deflationary as populations in the West start to mature and shrink. And the dollar, a strong dollar, is inherently deflationary because a lot of overseas markets have their debt priced in dollars, and also it makes commodities more expensive. So you could still get any one of these three outcomes. So being too dogmatic about one of them by putting all of your money in long duration bonds or all of your money in tech or all your money in banks is dangerous. You might be right, but the penalty for being wrong could be high. So I think the simple code here is be diversified. Don't be too dogmatic. Do think on a stock basis. If you do look at individual companies, do think about pricing power or look for fund managers who are obsessed by it. Because if we in an inflationary scenario, you will need companies that have pricing power to help them combat that. And be prepared for illiquidity and volatility. I haven't mentioned the word Woodford once, but it was clearly raised the issue of liquidity. And please don't forget that when you press a button that says deal on your smartphone or your laptop or your desktop, there has to be a counterparty to your trade. So if you're being so smart buying or selling, why is the other person being so dumb selling or buying? Please do think about that. And liquidity is not just pressing a button. Liquidity is getting the price that you want, in the size that you want, in the stock that you want, at the time that you want. Remember in 2008, FTSE 100 stocks, yes, you could trade them, but you had to take a 10% haircut just to get shot of it. So be prepared for illiquidity, be prepared for volatility. Just because liquidity is plentiful now and volatility is nowhere now doesn't mean they won't make a comeback, because believe me, when you're most relying on them not being there, most relying on liquidity, I can guarantee you that you won't be able to find it. And do look to protect the downside. We have had a wonderful 10-year run. And one way in which you can do that is seek out the unloved and the potentially undervalued, though you will clearly need to do your research there to make sure that you're not catching a falling knife and dealing with something that is perhaps terminally wounded. So I hope that was a helpful whirlwind 30-minute tour. I can start to see the questions dribbling through here. We'll try and take as many of, or coming through in speed actually. So we'll try and take as many of those as we can now in the next 15 minutes. The first one actually was emailed in beforehand. Can I cheer you up? Well, I hope I have done by being informative for the last half an hour. But can I envisage any scenario in which a Labour government would prosper or lead to a fresh bull market in equities, and which sectors might prosper? Well, I mean, the plan to take 10% of equity off stocks with companies with more than 250 employees and give it to company and give it to staff and increase the tax charge by 7%, is initially would look pretty negative. So I think if a coalition, say, was to steer them away from those policies, the more dramatic things, a little bit of balance would not be a bad thing. If they really did start to turn on the spending taps, you could get cyclical growth. To go back to our previous theme, you could start to see domestic stocks perform overseas ones. You could start to see value outperform growth. Specific areas could be interesting. NHS spending will be a priority for them. stocks like Kainos and Medica are designed to help those help the NHS. You could see more encouragement given to green and environmental type players, to construction type players, to affordable housing type players, Harworth perhaps. None of these are recommendations; they're names to consider. But I think possibly what you might get from a with a weak pound and a fiscal splurge would be inflation, which again would perhaps lead to the value over growth. But again, we need to be careful a little bit what we wish for here. Remember, the 1970s had huge amounts of inflation, partly because of an oil price shock, but also partly because of very lax fiscal policy. And although share prices went up in nominal terms, inflation killed them. The only things that did, inflation in the 70s killed bonds, it killed a lot of stocks. The only thing it killed cash. The only thing it really didn't kill was gold, which is a fantastic performing asset in the 1970s. Those stocks which did well in the 70s, defense stocks, which I'm not sure would be high of Labour's list of priorities, and then anything that had pricing power, and that was generally things that you put down your throat or put down the sink. So again, household and consumer staples might be sort of natural hedges if you did get a weak pound fiscal splurge inflationary style spike, and that would lead to many things that have worked for the last 30 years not working at all, and many of the things that haven't worked for the last 30 years working incredibly well. So I know that's a very general answer, and we're all waiting the results on Thursday night and Friday morning. So that, however, is probably where I'll leave the politics for now. And again, please, that's not meant to be in any way taking political sides on behalf of myself or my employer. In case you're wondering, I live in Brighton. My MP is Caroline Lucas, the only Green MP in the country. So that probably leads you to know that I'm probably about as neutral as you can possibly be, certainly in terms of where I live. Now, in terms of further questions coming in, where do I think the pound dollar will be at the end of 2020? Well, I'm an analyst, not a soothsayer. And my record on calling currencies is absolutely horrific. Anything that I say, anybody listening should probably go and do the opposite immediately. A lot of that will depend upon the election results on Friday. My suspicion is if you were to get anything that approaches a recession or a disappointment the other way, or a surprise away from inflation, people will gravitate towards the dollar as they did in 2007-8. It's the world's reserve currency. It's therefore the safest place to be, perception-wise. So if you got a recession, I think the dollar will come out on top. If you get global growth, maybe sterling would come out on top. But a lot of it will depend upon who wins on Friday and the Brexit results. And certainly, yes, we know the trade has worked for the last 3 or 4 years. Weak currency means overseas earners up to the detriment perhaps of domestic players. A strong pound helps to restrain inflation. That helps put more money in consumers' pockets and could favour domestic players and travel and leisure stocks, for example. So it is an important consideration, but currencies are so unpredictable. Basing your strategy on that is pretty dangerous. And I think short-term movements in currencies are dictated by positioning and leverage. And at the moment, I think the big shorts against the pound seem like they've been largely unwound. So there might not be an awful lot more to go. And even in the event of a clear-cut Tory win, we've still got Brexit deadline December 20 to think about. I suspect that will probably stop sterling going too far too fast because people know there's still got to be a deal. Can I put residential or buy-to-let property in the UK or overseas in a SIP? I'm not a SIP expert. I'm not going to lie to you. Complex products can be put in SIPs, and you can get certain providers to do it, but you would need to take financial advice and check with your SIP provider. And it's definitely, that's definitely not my area of expertise. Is the calming in oil due to structural reasons, or will it have a smaller role? I think clearly, if you're Greta Thunberg, you would love oil to have a smaller role in the world, and I think a lot of us would as well, because that would reduce hydrocarbon consumption and perhaps tackle global warming. I suspect this is probably one of those S curves that, as Bill Gates said, is a lot shallower. When it comes to hydrocarbon replacement with things like electric vehicles, I think it's probably going to be a lot shallower than we think to start. Then when we hit a certain penetration level, will be a lot steeper than we think, which again is, I think, therefore, there is a growing concern that oil assets will be stranded assets. I think that's why Saudi Aramco didn't get the valuation that Prince Mohammed bin Salman wanted. And I think that is an issue that is going to be rattling around in oil stocks for some time to come. I think more awareness of ESG issues mean that some investors may just fight shy of oil stocks full stop. But equally, there will be investors out there who will just take the view, hang on a minute, the world is still going to keep on burning oil for some time to come. The global energy sector is now less than 5% of the MSCI World Index. That's the lowest it's ever been. I wouldn't be shocked if those people who don't worry too much about ESG, but look purely at oil as an investment, might start to think there's some value there, particularly because there's some still decent yields. The other pressure, of course, is US shale. There's no shortage of the stuff coming out right now. If anything, a big plunge in the oil price would shake out a lot of the debt-funded US oil providers, US shale oil providers, but I don't think OPEC wants that either because it wouldn't be able to balance its own budget. So I think oil in the short term, shale is a key driver. In the long run, ESG and electric vehicle issues are a key driver. But I think with oil and energy stocks having underperformed horribly for the last 10 years, having outperformed amazingly well before that, I wouldn't be shocked if it would pleasantly surprise people on the performance front at some stage. What themes are going to come to the fore in the UK in 2020? Well, hopefully, I've gone through quite a lot of them. I think the election will dictate a lot in terms of which way the country goes politically and therefore economically. Brexit will be a huge issue there. Sterling will be, but I think the value in the UK, the UK market overall, on 12 times our forward earnings with a yield of 4.7%, is cheap relative to its history. It's cheap relative to international peers. What it needs is some political certainty, some political visibility, and just the economy not to go into recession. And I think that overall it could be a surprise because fund flows out of the UK market have reached nearly £15 billion since the Brexit vote. And as investors have been taking money out of the UK, corporates have been moving in. You've seen multiple takeover bids, whether it's Merlin, Inmarsat, EI Group, Fuller's Beer Business, Sky, Arm. Investors in financial markets might be frightened of the UK, but corporates, overseas corporates and execs have been prepared to move in the view that they think the pound's cheap, there's rule of law, an independent central bank, and that there's value to be had. So any degree of political stability might encourage a little bit more of that to the possible benefit of share prices. Should Trump be impeached? I think I'll leave that to Nancy Pelosi. I'm not an expert on politics, and I try and avoid politics because it just upsets people. I think the US, I think, if the tariff situation gets out of hand and there's a further escalation, I can't see that being good for global markets because, the 1930s didn't show that tariffs didn't cause a global depression, but they certainly made a difficult situation worse. So I think markets are hoping for a trade deal. I think they're pricing in a trade deal. They've climbed the wall of worry. What you don't want now is markets to slide down the slope of hope because there isn't a trade deal. So I think that is a key concern. I mean, US corporate earnings estimates are looking for growth of around 15-20% next year after a slowdown this year, partly because of the base effect from the tax cuts. That to me feels a bit aggressive, but I've been wrong before. I mean, the US people, lots of people have been waiting for the US to start underperforming. It hasn't happened yet. It's got the tech stocks that people have been wanting. And if we stay in this low growth, low inflation world, the US may continue to outperform. But again, looking at that chart of the world's biggest stocks by decade on a 10-year view, the Case-Shiller PE multiple now is around 30 on a cyclically adjusted basis for the US. It's only been higher than that twice on a sustainable basis. The late 1920s and the late 1990s, neither of those worked out well. And even if the US doesn't collapse, and I suspect, it's going to have to wait a long time for earnings growth to catch up with where it is on that cyclically adjusted multiple. So even if the US doesn't do badly doesn't go down in a big hole on a 10-year view, there is a risk it goes nowhere fast as it just needs earnings estimates to catch up with where the index is. So I would, on a 10-year view, be suspicious using Shiller Cape as a historical guide, even in the knowledge that the past is not necessarily a guide to the future. Can the UK economy cope with a significant increase in national debt? Oh dear. It's about 85% of GDP right now in aggregate, about £1.8 trillion. If you read the Rogoff and Reinhardt book, they would say 80% plus is a big trigger point for economic difficulties as interest starts to suck away too much productive capital. The UK's annual interest bill, I think, is about £45 billion from memory, and that's with interest rates around the absolutely rock bottom. So it shows you that we can't really afford much higher interest rates. It shows you it's going to be very, very hard for us to grow our way out of this difficulty with global debt having gone up by 50% since 2007. That's, I think, why you probably will get governments pressing the spend button, even if the money isn't there necessarily, to try and create growth and inflate the debts away. Tech stocks over the 10-year term, we've kind of touched on that. I mean, again, they're terrific companies. I do think you will see some regulatory pushback. I think regulators are more concerned about privacy than customers. I think the real death knell for the tech stocks like Facebook, like Alphabet, like Twitter, for example, would be if you were to see monthly average users start to go down, and they're not. They're still going up. So customers, users of those services, of which I am not one, certainly when it comes to Facebook, and that's just a personal choice. I will choose privacy over the ability to live my life vicariously. I think if you start to see user numbers go down because people think, actually, I value my privacy more than my ability to look at pictures of Katy Perry or talking melons, then I think that's when these companies have got problems. But if it's just regulators breathing fire at them, I think generally they'll brush it off. But share price wise, they won't if user numbers start to go down and people take a pro privacy versus pro melon choice. And I think that will be a bigger challenge for tech stocks. Where are we now? Is there any value at looking at green stocks in 2020? Well, it depends which green stocks you're looking at. I mean, I think the ESG momentum is going to be incredibly strong on the environmental as well as social and governance themes. And I think that is an area of going to be great focus for investment, R&D, and government investment. Tesla, I hope the guy succeeds. I hope the electric car does take us the way forward. I find him a difficult person to deal with from an investment perspective. Not that I've ever met him. I find Tesla a confusing stock because its valuation is very extreme. It's got buckets of competition. It's got some pretty ropey corporate governance, and I do suspect that it might not be necessarily the long-term winner that everybody hopes it will be, that its valuation hopes it will be. But I think you will clearly see this as a potential theme. But again, with any theme, you've got to be accessing companies with barriers to entry, with good management who've got integrity, and where there are barriers to entry and where there are sensible valuations. Is it possible for casual investors to short specific stocks or indices? Specific stocks is incredibly difficult. You've got to borrow the shares and the risks are absolutely enormous, and you really got to be incredibly careful. Indices, you can do it, again, being incredibly careful through ETFs, exchange traded funds, because you can buy reverse ETFs that go down, that go up in value as the index go down. But note that they are very volatile. They do need markets to go down in a straight line rather than on a volatile basis because they're priced at the end of each day. So you don't necessarily capture all of the downward price fall. You can also do it, I would guess, between leveraged derivative products like spread bits and CFDs, which AJ Bell does not offer. And I would say they're incredibly dangerous products. I'm not saying don't do it, but I think you're going to need a very big buffer zone. You're going to need to do your research very thoroughly. And even if you're right in your research, you can still be wrong on the stock for a very long period of time. I think if you are looking to take on some of these highfalutin or expensive stocks, one piece of advice I was always given by a hedge fund manager when I was on the broking side at the UBS Investment Bank was always wait until the share price of these stocks have halved. Because that's when the fans, the zealots, the believers stop buying on the dips and start selling on the rallies. Would I mind showing slide 25 again for the screenshot? You won't need the screenshot because we'll be sending the slides round, so please don't worry about that. Again, just to repeat, an email will be sent round in about an hour after the webinar asking you to fill out a feedback form, and you will get information on where to download the slides. And if you don't receive that email for any reason, check the junk folder that you've got. And also this session has been recorded and a video will be made available on our website at some point in the next week or two. How best to invest in artificial intelligence? There are special dedicated funds for that and dedicated ETFs that you might look to. The Robo is one of the ones that spring to mind. So please do your research on that. But again, you need to make sure that they overall fit your time horizon, long-term target returns, and appetite for risk. And of course, by appetite for risk, I mean ability and willingness to withstand losses in the search for profits. What could cause the decline of FANG and tech stocks? I think regulation is one, but I think loss of customers would be the biggest one, and competition catching up. What will be the average growth over the next 10 years? Doesn't say in what. I mean, roughly earnings growth has trended in the UK over the last 10 years at around 4 to 5%. So I'm not going to argue with that. If you think about it, that's probably about right. Inflation of 2 or 3%, a bit of corporate productivity growth. I think trend earnings growth of 4 to 5% in this environment is pretty good. And therefore, I wouldn't view that as unrealistic. And the UK on 12 times earnings isn't mad in that respect. In the end, stock markets will not, over the very long term, outpace corporate profits growth. They just can't do it. And at the moment, with the US probably pricing in more than that, that's why on a 10-year view, if I was forced to take a guess, I'd be a little bit more wary of the US because it is pricing in above trend earnings growth on a consistent basis, whereas the UK, for example, isn't. And I don't think emerging markets are either, for example. What do I see in the trend for tracker funds? I think tracker funds are potentially extremely useful tools. They're low cost, they provide broad diversification very quickly, and they are a quick, simple way of getting market exposure. The one thing that you must remember is that tracker funds naturally expose you towards the biggest stocks, the ones that have already done well. And also, they are the general tracker fund is a Delta 1 fund, which means it will go up 1% when the market goes up 1%, but it will go down 1% when the market goes down 1%. We have not been in that situation for 10 years, so please don't forget it. Tracker funds provide great access, quick, cheap, simple, but you need to know how they provide performance, you need to check their fees, and you need to remember that they will go down if and when the markets go down. And to the best of my knowledge, central banks have not abolished recessions. They have not abolished bear markets despite their best efforts to do so. Will we mine potash in Yorkshire? That's my home county. A lot of jobs are resting on it. I can tell you for free. So there'll be a lot of people hoping that Sirius Minerals is a huge success. This is not investment advice, but Sirius Minerals is not my kind of stock. I don't like buying into stocks personally with my own money. And by the way, I'm actually not allowed to invest personally with my own money. It's all done on a discretionary basis. So you, ladies and gentlemen, can't be frightened that I'm taking the mickey by talking about things that I own myself. I personally don't like buying into stocks that are loss-making pre-money, because they often come back to you for more money, and dilution is the ultimate enemy of the investor. The idea is that these people pay you dividends, not that you give them more money. So I would rather wait for the early stages, wait until they break into a profit, because if they do, there's going to be a hell of a lot more to come anyway. But that's just a matter of personal preference and risk management. I was trained as a value investor. I'm a relatively risk-averse investor. It's me personally, I'm never happy than when I'm clipping dividends and clipping coupons, but I leave all of those decisions to my own personal financial advisor who runs things on a discretionary basis. UK REITs are having a bad time recently. Is it limited to retail? I think that's a really good question. I think it's got a lot to do with it, but it's not exclusively that. I think if you look in general, if you look specifically at the UK REIT sector, yes, you have Intu, British Land, British Land Securities and Hammerson trading at 30, 40, 50, 80% discounts to net asset value. At the other extreme, you have companies trading at premium to net asset value. Tritax, Big Box, Workspace, Segro, the warehousing, logistics, storage players. So it's very stock specific. I think generally, the more exposed you are to retail, yes, the bigger the discount to NAV. But the more exposed you are to the City of London, the bigger your discount to NAV. The more exposed you are to big project development, the bigger your discount to NAV, because people are frightened of the city dropping in a hole after Brexit. They're frightened of London suffering as a financial centre, and they're frightened about what could happen to the economy, therefore to those big developments. So at the moment, it seems to be retail bad, big development bad, city bad. If you were to get any visibility in all of those three, or they were to prove to be a lot worse, not as bad as expected, that is your investment case for REITs. We're running out of time and I'm running out of breath. Should private investors take any notice of broker ratings? If you go through our archive, and I confess from the top of the list, I don't know how far it goes back on our website, but every January I write a piece that looks at which stocks have got the most buy and sell ratings for the year ahead. But I also don't do it just in terms of that, but relative to their market capitalization. And I actually look at number of buys, market cap per buy and market cap per sell. Generally, the stocks with the least amount of market cap per buy recommendation have found it pretty hard work. It doesn't work so much with the other ones, but I wouldn't say don't pile into a stock. But if a stock's done brilliantly and all 30 brokers are buyers, you're probably entering slightly more risky waters than if you're looking at a stock that's performed horribly and all 30 brokers are sellers. Because again, looking at the Templeton principle, the best bargains are to be had and the best price to be had where there's pessimism, not where there's rampant optimism. So yes, do be aware of broker research, because it sets the sentiment, it sets the consensus, it lets you know what current thinking is. I'm not sure it's a fat lot of use with regard to future thinking, because I say this as I used to write it myself, and most forecasters, Buffett says, tell you more about the forecaster than they do about the future, because in the end, none of us have got a crystal ball. So one final question, if I may, and if I haven't answered your question, please email our customer services and marketing teams, and I will then make sure that those questions get answered either by myself or by my colleagues or by an investment team. So final question, is it worth investing in UK stocks, or should we look elsewhere? I think the UK is cheap. The UK is underperformed. It's unloved. You've got fund flows, and it's cheap on an earnings basis, and it's cheap on a dividend yield basis. So that is a good start. At the same time, if we were to get a particularly inconvenient election result on Friday, and I would probably view that as a hung parliament, because that means we're basically no better off than we've been for the last 2 years. I think you'll be struggling for an earnings catalyst for the UK. Yes, the pound might go down, and yes, the overseas earnings might go up again, but I think it will make it hard for the UK to make progress. I think some degree of visibility on the government, on Brexit, and all those things will help the UK enormously, as would even just a little bit of a sniff of domestic growth. So with those caveats in place, I think the UK could be very interesting. But if it doesn't get them, it could well do what it's done for the last 3 years, which is basically go sideways. So thank you very much for your time, everybody. Here's a final disclaimer, just to make sure. We really do appreciate you dialing in and spending an hour of your very busy day with us. Again, just to repeat, any questions unanswered, please email customer services. We'll get back to you. We will send out an email in about an hour from now, asking you to fill out a feedback form and also providing with information on where to download today's slides. And if you don't see it, please check your junk folder. And this session has been recorded, and we will make a video available on our website at some point in the week or two. May I all wish you a very happy new year, and may it be a successful and prosperous one.